Hey, this is Jeffrey with another edition of Stock Smart, February 25th, 2021 edition. Hope you're all doing well. Thanks again for listening to the show. So Gamestop back in play, GME cruising up big time yesterday. It's up to 138.61, up 50.79% today. You know, the shorts in this are not that great. They may be 35, 40% short at this point, but that's not a huge short that should move the stock as much as it's moved. So something's different. You know, they had a catalyst yesterday as the CFO got fired. You know, the new guy who's from Chewy, they perhaps believe now they can turn it around a little bit better. So it did have a positive catalyst in a way. Told you on Monday that Keith Gill, who's the famed Reddit trader, bought 50,000 shares of the stock. So he's done very well. And that was when it was at 35.40. So we know it's back in play, but we're not seeing kind of the information on the Reddit bulletin boards that we'd see about organizing people and getting everyone to be involved. So it's a little more interesting, a little more secretive this time. But GameStop is in play. I would tell you that my kids, who are both studying for the financial services industry now, both of them, they bought a GameStop option, a call option, long dated, and they bought it about a week ago. And let's see, it was an April 16th, 600 call, meaning the stock would be in the money when GameStop went to 600. But the point is you can make money on out of the money calls if they're long dated and the stock moves in a positive direction. So they don't have to be in the money as long as they have more time to get in the money. So essentially this call went up yesterday. The call went up 900% in value. So the call price when my kids bought it was about $1.20. So, or $120 for the 100 share equivalent of the call purchase. By the afternoon yesterday, it was $1,100 in value total overall, or about $11, $12 to get rid of it or to sell it. And that was the bid on it. So I told the kids this morning, get up and get it sold, because I don't see that there's a long-term catalyst in the stock. And just like if any of my listeners asked me, I would say, I wouldn't be a buyer right now. I would definitely stay away from it as far as you can. But the kids sold it. They made a nice profit on it. Sold it around $11 for the call. There's a huge spread between the bid and the ask price. So a lot of times when people say, oh, I bought these calls, I made a lot of money, realize that on the other end, there's a market maker who understands what's going on here and isn't going to give you the price that you should normally get or you'd normally get for a regular stock in play. Because I'll tell you, the bid price was something like 11. The ask price was like 26. So that is a massive, massive spread on that call. And that's because people realize, hey, we don't know where it's going. It's so volatile. The movement, if we're going to be in it, we're not giving you what you want on this option. So anyway, that's what I want to start with. So podcast is growing in terms of downloads. Thanks again. We're about 10% per week over the last week of growth, which is amazing. So thank you so much. Again, we're going to have a huge announcement on this podcast and something that's new and brewing. And I'll share more with you on that in the coming weeks. So CCIV, the SPAC that bought Lucent Motors, stock was down pretty heavily yesterday. Today it's making a little bit of a bid up to around 29.78, up about 4%. Company has value at 37. I think there's so much shell shock right now with the news here on this. Investors got screwed because insiders bought it for 15, that the stock's reeling a little bit. It's going to take some of that stench to go away before people get involved. I do see value here. I'm not necessarily going to buy it for clients, but I do see value here. Under 35, 33, 34, there's some value here. So if you're interested in the company, another electric vehicle play, CCIV. So Charlie Munger came out yesterday, and he's the famed investor and friend of Warren Buffett. He also was a client of mine at one point. He's a famous attorney with a firm called Munger, Tolles & Olson, probably one of the most prestigious law firms in the country, always in the AmLaw top 5 or 10. So Munger on SPACs, which Churchill Capital is, again, SPACs are blank check companies that raise money in initial public offering at about $10 per share. And people buy the SPAC, pushing up the value of the SPAC without knowing what company that they may be invested in. So it's kind of garbage. Munger said, investment bankers will sell SHIT as long as can be sold. So let's see, the VIX is rising again as the market continues to kind of unwind. VIX is up 12% today to around 24. S&P 500 down 66 basis points. And again, we're going to start seeing this. I think the correction's coming where we're going to have a little bit of a correction here, maybe 5% when we're getting out of earnings. Let's take a look at a stock, not exactly a stock
watch,
but an ETF. And then here's the marketing language. This ETF, one of the powerhouse Spider products, provides exposure to an index that includes companies from the following industries: diversified financial services, insurance, commercial banks, capital markets, real estate, investment trusts, thrift and mortgage finance, consumer finance, real estate management and development. It is the XLF. The XLF Financial Spider contains the who's who, essentially, of the financial players in the domestic economy here. I'm a believer in anything bank related right now, especially because interest rates, as inflation creeps, we're going to get a creep in interest rates. And that's how banks make their money. They make their money in the spread. And the spread is what they charge for a loan and what they pay for the loan. And so as that continues to rise, that spread gets greater and greater, banks will continue to do well. And so, big believer in the XLF. The chart is a tremendous chart. It's up about 13.8% this year already. And we're only in 8 weeks in trading this year. So that stock and the stock technicals on the stock are just, or I should say on the ETF, are just tremendous. Really has a great movement, great pattern all the way back to last year. And so again, XLF. So I got a question from
the average
Robyn.
Investor.
And Robyn wants to know, and we talked a little bit about this yesterday, about the market cap weight and equal weight. And maybe Robyn kind of heard that and she wanted to know a little bit more. And she wanted to know the difference between an equal weight ETF and a market cap ETF. Think of like the S&P 500. Think of it as a pie chart. With a market weight ETF, essentially the pie chart is broken up into slices based on the size of the market cap. So you might have Tesla as having a huge piece of that pie. And then you might have another company like Dow that's smaller. And Amazon has another huge piece. And then McDonald's is smaller. So that's what it is. So that ETF that's market cap weighted is basing it based on the market cap weight of the company. Now, when you're in an ETF that's equal weight, every company gets the exact same slice of the pie. Now, generally, because those growth stocks, which are 28% of an S&P 500 of a market weighted ETF, like an SPY, 28% of that is in 10 companies. We all know them: Apple, Microsoft, Amazon, Facebook, Tesla, Google. Okay, we know them. Those are, I don't know, listed 6 or 7, but there's 10 of them, and they essentially make up 28%. So you can see that's kind of a disparity. In an equal weighted index, again, all 500 companies have the same weight in the index. So you can see right now there's an interesting divergence, and this doesn't generally happen. If you look at a chart, so if you just lay the SPY and the RSP over each other, and the RSP is essentially the equal weight S&P 500, where the SPY is the market cap weighted S&P 500 index. So if you lay that over the top of each other, you'll notice that generally the SPY, which is the market cap weight, because those in the last 10 years especially, those heavy hitting big time stocks that were 28% of market cap weighted ETF have really outperformed and done well. So in general, the SPY has outperformed, but not this year. Look at it this year. Year to date, the RSP is nearly double what the SPY is in performance. So the RSP, which is the equal weighted S&P 500 index essentially, is up about 7.8 or 8%, where the SPY is only up 4%. What does that tell you? And you can see it if you look at each individual stock. Those stocks like Apple, Amazon, Facebook, they're not performing that well right now. And really what that can be attributed to is you see energy has done really well in the last 2 months, and you'll see the financials have done extremely well. So again, hey, thanks for the questions. Keep them coming. Jeffrey at jeffreykamys.com. And we'll see you next time on Stock Smart.